Welcome back to Wealth Vision, the channel where we uncover the hidden money secrets, retirement strategies, and government benefit loopholes most Americans never hear about until it's too late. Now listen carefully, because what you're about to hear could save you thousands of dollars during retirement. Most retirees believe once their Social Security check arrives, that money is finally theirs to keep. But here's the shocking truth. Nobody talks about the IRS can quietly take back a huge portion of your benefits through hidden tax rules that millions of Americans don't fully understand. And it's happening right now. Every single year, retirees lose thousands of dollars unnecessarily, not because they broke the law, but because nobody told them about the loopholes hidden inside the Social Security tax system. What makes this even crazier is that two retirees can receive the exact same Social Security payment, yet one pays almost nothing in taxes, while the other loses a major chunk of their retirement income. Same benefits, same age, completely different outcome. Why? Because there are legal strategies, hidden income rules, and timing loopholes that can dramatically change how much money you actually keep after retirement. And trust me, one small mistake with your retirement withdrawals could trigger higher Social Security taxes, bigger Medicare premiums, and financial losses that continue for years. But the retirees who understand these loopholes know how to legally reduce the damage, and in some cases, avoid it almost entirely. So in today's video, we're exposing the Social Security tax loopholes every retiree needs to know, right now, including the hidden rule most people don't discover until after they already lost money. Now, today's topic is something most retirees never see coming, until it's already costing them thousands of dollars. Because here's the truth, a lot of Americans believe Social Security benefits are mostly tax-free, but that's not always true. In fact, millions of retirees are paying far more in Social Security taxes than they legally need to, simply because nobody ever explained the loopholes hidden inside the system. And what makes this even more shocking is this: because the government's Social Security tax system is filled with hidden income rules, timing, strategies, and loopholes that most people never learn about until retirement is already underway. And today, we're breaking it all down in simple English. So make sure you stay until the end, because one of the biggest loopholes has nothing to do with how much Social Security you receive. It has everything to do with where your retirement income comes from. And almost nobody talks about it. Also, before we dive in, if you care about protecting your retirement, avoiding financial mistakes, and staying updated on Social Security and Medicare changes, make sure you subscribe to Wealth Vision right now. Because these rules keep changing, and the people who stay informed usually keep more of their money. Now, let's get into it. The first thing retirees need to understand is this: Social Security taxes are based on something called combined income. And this is where the confusion starts, because the IRS doesn't just look at your paycheck. They use a special formula. They take your adjusted gross income, add any non-taxable interest, then add half of your Social Security benefits. If that number crosses certain limits, your benefits can suddenly become taxable. And here's the scary part. Those income thresholds were created decades ago, but they were never properly adjusted for inflation. That means more retirees are getting trapped every single year. Even middle-class retirees who never considered themselves wealthy are now paying taxes on Social Security. And many don't even understand why it's happening. But here's where things get interesting. Not all retirement income is treated the same way, and this creates one of the biggest loopholes in the entire system. For example, traditional IRA withdrawals usually count toward the income formula that determines whether your Social Security becomes taxable, but Roth IRA withdrawals often work very differently, and that tiny detail can completely change your tax situation. Imagine retirees each needing $20,000 for emergency expenses. One takes the money from a traditional IRA. The other uses a Roth IRA. One may trigger higher Social Security taxes. The other may avoid them almost entirely. Same amount of spending, completely different tax outcome. And this is why smart retirees pay close attention to where their money comes from during retirement, not just how much they spend. Now, here's another problem most people never expect. Higher retirement income can also increase your Medicare premiums. So retirees sometimes get hit twice at the same time. First, more of their Social Security becomes taxable. Then their Medicare costs rise too. And this surprises people every single year, especially retirees who suddenly take large withdrawals from retirement accounts. Maybe they're helping family, maybe paying medical bills, maybe fixing the house. But one large withdrawal can accidentally push income into dangerous territory. And that's why timing matters so much in retirement. In fact, one of the most powerful loopholes revolves entirely around timing. Financial planners sometimes call it the low-income window. And most Americans have never heard of it. This usually happens after retirement, but before Social Security and required minimum distributions fully begin. During this period, income may temporarily drop. And that creates opportunity, because retirees may be able to move money from traditional retirement accounts into Roth accounts while staying in lower tax brackets. Now at first, that might not sound exciting, but here's why it matters. Large traditional IRA balances can later trigger bigger taxable withdrawals, which can increase Social Security taxes and Medicare premiums later in life. But Roth accounts can offer more flexibility, and retirees who plan ahead sometimes save thousands over time because of this strategy alone. Now, here's the part most people miss. Retirement taxes are not just about how much money you have. They're about how your income is structured. That changes everything. And this becomes especially important once required minimum distributions begin. Because after age 73, many retirees are forced to withdraw money from traditional retirement accounts, whether they need the money or not. Those mandatory withdrawals can push income higher very quickly. And suddenly retirees who thought they were financially comfortable start facing unexpected tax bills. Now let's talk about another hidden trap. Municipal bonds. A lot of retirees believe municipal bond income is completely harmless because it's often federally tax-free. But here's what surprises people. That income can still count toward the formula used to determine Social Security taxation. And retirees don't realize this until it's already affecting them. Again, this system is filled with hidden interactions most people never hear about. But there's another loophole retirees should know. And this one can be extremely valuable for people who give to charity. It's called a qualified charitable distribution. Here's how it works. Certain retirees over age 70 and a half can send money directly from an IRA to a qualified charity. And when done correctly, that money may avoid being counted the same way as taxable income, which means it could help reduce Social Security taxation and lower the risk of Medicare premium increases. Now, obviously, this strategy isn't for everyone, but many retirees never realize it even exists. And that's the bigger issue. Most people enter retirement without fully understanding the tax rules attached to their income, and mistakes become expensive very quickly. Now, here's another huge problem. Many retirees focus only on this year's taxes. But smart retirement planning is really about lifetime taxes. Sometimes paying slightly more taxes today can actually save far more money later. That sounds strange at first, but think about it this way. Would you rather control smaller taxes now or get hit with much larger taxes later when required withdrawals pile up? That's why many financially savvy retirees intentionally create income earlier under controlled conditions, because controlled taxes are often better than surprise taxes. And here's where the emotional reality hits hard for many retirees. People spend decades working, saving, and preparing for retirement. Then retirement finally arrives, and suddenly the rules become incredibly confusing. Different tax rules, different Medicare rules, different Social Security rules. And unfortunately, most people are left trying to figure it out on their own. But once you understand how these systems connect, you gain something powerful. Control. And that control can protect your retirement income for years. Now let's talk about another loophole almost nobody considers. State taxes. Some states tax Social Security heavily.